Red arrows on Wall Street on this first trading day of December. Not the kind of kickoff investors were expecting for the final month of a year marked by stock market records. The Dow average is now back to the 16,000 mark, and the S&P 500 index stands at exactly 1,800. So why the sell-off? Well, some blame it on disappointing consumer sales over the long holiday weekend, which pulled down shares of a lot of major retailers today. And we'll have more on that in just a moment. Not even encouraging economic data seemed to help. Stronger growth in U.S. manufacturing in November and robust construction spending for October. So looking at the closing numbers, the Dow fell 77 points, the Nasdaq was down 14, the S&P lost about 5 points.
Well, Susie, also not helping stocks today, comments from a Nobel Prize-winning economist who says to him, the U.S. stock market is starting to look bubblicious. Now, that wasn't Robert Shiller's exact word in an interview with a German magazine, but that was his message. The Yale economist behind the Case-Shiller Home Price Index says he sees the world as, quote, very vulnerable to bubbles, and not just in stock prices, but in property markets as well. Shiller called the U.S. economy, quote, still weak and vulnerable. He says technology and financial sector stocks seem most stretched. He still sees value in energy and healthcare. So far this year, the broad-based S&P 500 index is up more than 26%.
Well, Jim Paulsen isn't buying the bubble talk. He says there's still a lot of upside in the stock market. He's chief investment strategist at Wells Capital Management. Jim, nice to have you with us. So tell us why you're not expecting any bubble trouble after a Nobel Prize economist is saying that things are vulnerable.
You know, Susie, I think the primary thing that creates sort of the bubble economy and ultimately a recession is just simply too much confidence about the future. When all the players, consumers, businesses, policy officials, everyone gets really bullish about the future, they start engaging in dumb behaviors. They stretch their balance sheets, take on too much debt, hire too many people, buy that second summer home. And that's the type of thing that ultimately has to be corrected. And I think that confidence is better today, but we're still at confidence levels that are below average by long-term historic norms. And I think the description I would give is we're more comfortable maybe, but we're certainly not euphoric, the type of confidence that would beget behaviors that would bring about a bubblicious like risk. I don't think we're anywhere close to that.
Oh, but show me your Nobel Prize, Jim Paulsen. Show me yours. You know, I take all those points. We've got low inflation. We've got rising interest rates that really aren't at a point where they're really posing competition for stocks. But you still have an economy that's not growing all that fast and a market that has. Can't you concede that the market may be more vulnerable at these levels to a shock, whether it's something that comes from the outside or from Washington or something we can't foresee, than it was a year ago?
Oh, I think that's true, Tyler. There's no doubt about that. Every day the market goes up, it's somewhat more vulnerable than it was when it was at very depressed levels. But I think one of the things to keep in mind, the market's up a lot from 2009, but where it was in 2009 was equally artificial. I mean, it had fallen a lot, not necessarily because of fundamentals, but merely out of fear. And it stayed at these levels for a while because of excessive fears about one Armageddon or another, all of which proved false. They didn't ever occur. So in some sense, the rise in the market is just getting us back to a more meaningful reality after underestimating that for so long. And so we're up, but I don't think we're extended. We're selling at around 16 times trailing earnings right now. And market history would suggest that market peaks, the major market peaks, are in the low 20s in terms of multiples. I think we're going to continue to have earnings growth over the next few years, and we'll probably have a rise further in valuations. It won't be a straight line. Indeed, next year we might get a correction at some point. But I think we're a long ways from the type of like 20 multiple market, which is more vulnerable to a major correction. All
right, so then the challenge for investors is finding value in this kind of a market. Where can they find value?
Well, I would look within this country. First, I would like to be a little tilted offshore, Susie, towards the international markets. I think the dollar is going to remain somewhat weak over the next couple of years, favoring both international, developed and the emerging markets. Here, I kind of like the cyclical markets in the early part of next year. I think the market might run ahead yet for a while into the early part of next year, and you want to have stuff tied to the economy. We'll continue to get good manufacturing reports. I think we're going to get good economic reports. So I like the materials and industrial stocks, kind of the manufacturing sector. I still like the financials here. Maybe later in the year, if interest rates back up a little bit, and we get more pressure on the market, then you might want to move your allocation more defensive, maybe to the staple stocks or something in that vicinity.
All right, we're going to have to leave it there. A lot of good information. Jim, thank you so much for coming on the program.
Thanks a lot.
Jim Paulsen, Chief Investment Strategist at Wells Capital Management.